It was bound to happen. We have our correction in gold, $3,919.60 per ounce on the CNBC COMEX futures for December. Hello and welcome to the Northern Miner Podcast. My name's Adrian Pocobelli. So a significant correction in gold, I suppose at the end of the day, we could call that 10%. I believe that is the technical term, with a bear market being 20%. And that would be quite a development, wouldn't it? The last thing anybody is talking about is a bear market in gold. Now, the correction coming on the heels of news of a potential deal between China and the United States, it feels premature to call it a deal. It is more of a framework, as is being discussed online. So, gold correcting, rare earth miners also correcting. We have a story from Reuters. Rare earth miners fall as U.S.-China truce to pause tariffs, export curbs. So a lot of optimism coming out of the United States and China on the recent meeting between the counterparts, diplomats on both sides. Of course, none of it being ratified before a meeting of the leaders, which is coming up, which we're going to discuss. In the meantime, Trump has been traveling Asia, signing critical minerals deals. One of particular note in Japan. We have a fresh story from the Washington Post. Trump signs rare earth minerals deal with Japan ahead of China meeting. And I think the headline captures the nature of the deal well. It all seems to be as potential leverage, negotiation, preparation of sorts before a meeting with China. I mean, as we've discussed and as many commentators have noted, there is only so much you can do when the processing occurs in China. And again, we keep seeing this 90% number on rare earths, which perhaps is true when we speak generally, but the reality of the issue, when you dig deeper, is that 99.8%, we read last week, of heavy rare earths are processed in China. And as people note, not all rare earths are equal. So it's going to be more than the stroke of a pen to solve this issue. Of course, this is the first step, but as commentators have been noting, this has been 3 decades in the making, what China has accomplished in terms of their expertise. And with all of the restrictions on the technology and the people, it's going to be interesting to see just how fast the United States can catch up here. It's almost a kind of test of the systems. Interestingly, some commentators describing the United States investing, taking equity stakes in mining companies as a kind of copying of the Chinese model, this kind of state-run capitalism. It's an interesting point. So to a certain degree, on the immediate sense, yes, this is about rare earth metals. But when we zoom out, we can see the rare earths as a metaphor of sorts. Put it this way. It's going to be interesting to see how resilient the United States is here in 2025. So here is a new deal signed with Japan. Trump met with Japan's new Prime Minister Sanae Takaichi, who heralded the start of a new golden age in the bilateral relationship following tricky trade talks. So as was described this morning on Bloomberg News, a very warm meeting here between Trump and the new Japanese Prime Minister Sanae Takaichi. This is by Karl Zakarzewski, Natalie Allison, Michelle Yi-Hee Lee, and Matt Weiser. In Tokyo, President Donald Trump and Japanese Prime Minister Sanae Takaichi on Tuesday signed a framework agreement to cooperate on critical minerals as the United States seeks to limit dependency on China for the materials, which are essential components in everything from cell phones to jet engines. Trump inked the agreement 2 days before he is scheduled to meet with Chinese leader Xi Jinping in South Korea, where the leaders will seek to stabilize their economic relationship following months of a tit-for-tat trade war. China has leveraged its dominance of rare earth minerals amid the negotiations, announcing earlier this month that it would dramatically expand export restrictions on them. At a signing ceremony at Akasaka Palace less than a week after she was named prime minister, and immediately thrust into high-level diplomatic engagements, Takaichi faced a key test of whether she could build inroads with the American president as the countries grapple with the threat of China, security commitments, and trade tensions. Trump indicated that Japan had agreed to increase its defense spending following pressure from his administration, but he did not respond when asked about the specific amount he was seeking. It's kind of interesting. I mean, if you don't have the rare earths, though, what is all this defense spending going to be spent on? Finally, the new prime minister billed the critical minerals deal as the beginning of a, quote, new golden age of Japan-U.S. relations, appealing to the president's penchant for gilded aesthetics. U.S. negotiators have sought a one-year reprieve from China's critical mineral restrictions ahead of Trump's meeting with Xi on Thursday, though the president has cautioned no deal will be final until the leaders meet face-to-face. Indeed, I don't understand why China would agree to that, because in a year, a lot could change. The Japan agreement is one of a flurry of critical mineral partnerships that the White House has secured with countries in the Indo-Pacific region, including Australia and Malaysia. So interesting developments there. And once again, critical minerals playing a central role in the relations between major powers here. And continuing on this same story, Trump strikes deals on trade critical minerals in Southeast Asia. This is Reuters via mining.com. The United States signed a flurry of deals on trade and critical minerals with 4 Southeast Asian partners on Sunday, looking to address trade imbalances and diversify supply chains amid tighter export curbs on rare earths by China. U.S. President Donald Trump, who is in Kuala Lumpur, so this was on October 25th, to attend a summit of the Association of Southeast Asian Nations, signed reciprocal trade deals with his Malaysian and Cambodian counterparts, as well as a framework trade pact with Thailand that will see the countries work to address tariff and non-tariff barriers. The United States would maintain a tariff rate of 19% on exports from all 3 countries under the deals, with the levy to be reduced to 0 for some goods, according to joint statements released by the White House. Now, it's interesting because China has been working with Malaysia in terms of rare earth processing. Scrolling down, Malaysia not banning rare earth exports. Trump on Sunday inked 2 separate U.S. deals with Thailand and Malaysia seeking cooperation to diversify critical minerals supply chains amid competing efforts from Beijing in the rapidly growing sector. Reuters reported exclusively this month that China was in talks with Kuala Lumpur on rare earths processing, with Malaysian sovereign wealth fund Khazanah Nasional expected to partner with a Chinese firm to build a refinery in Malaysia. China, the world's top miner and processor of rare earths, has imposed increasingly stringent export controls on its refining technology, sending global manufacturers scrambling to secure alternative supplies for critical minerals used widely in semiconductor chips, electric vehicles, and military equipment. Malaysia agreed on Sunday to refrain from banning or imposing quotas on exports to the U.S. of critical minerals or rare earth elements, the country said in a statement. The statement, however, did not specify whether Malaysia's pledge applied to raw or processed rare earths. With China protecting all of its rare earths technology and personnel, why would China then give its technology to Malaysia basically to share with the United States? So to a certain degree, this doesn't add up, we could argue, or at least we don't have the full story. So this is the big question, I suppose, as all these deals are being signed, is how much of this is optics and how much of this is actually going to be what we might call real change. So Trump is in Asia, with critical minerals seeming to be at the top of the agenda, and we will see what happens with the meeting between Trump and Xi later this week. Continuing on, we have a story from Politico. The Europeans weighing in, von der Leyen touts new plan to break reliance on China critical minerals. And this is October 25th by Louise Guyot. The European Commission will present a new plan to break the EU's dependency on China for critical raw materials, President Ursula von der Leyen announced on Saturday. The EU executive chief warned of, quote, clear acceleration and escalation in the way interdependencies are leveraged and weaponized, in a speech Saturday night at the Berlin Global Dialogue. She also added that the EU's response, quote, must match the scale of the risk we face in this area, adding that, quote, we are focusing on finding solutions with our Chinese counterparts. But we are ready to use all of the instruments in our toolbox to respond if needed, the head of the EU executive warned. Now, the EU is actually facing a major issue with, of course, the Dutch seizing Nexperia, and then, of course, the Chinese responding that they're just not going to send any of the components or chips. We're going to look at that story in a second. So EU and China relations over critical minerals and the seizure of assets is getting quite real. Also, a story in the Financial Times, Europe struggles to catch up and race to stockpile critical minerals. And this is by Alice Hancock and Camilla Hodgson. Europe must move faster to stockpile critical minerals or risk falling behind in securing supplies, industry leaders have warned as the bloc seeks to reduce reliance on China for materials for defense and clean technology. And it's also robotics, it's also anything that's cutting edge, that's next generation economy requires these critical minerals. Brussels will launch a consultation on stockpiling before year-end on funding and what minerals should be acquired, according to EU officials, essentially to diversify away from foreign sources. So they're going to launch a consultation before year-end. I mean, perhaps they need a little more urgency. I've been saying on this show for years, actually, that stockpiling is a good idea. And in a sense, what, I would say today is right now everybody's concerned about the critical minerals, but then we see metals like nickel, languish at lows. Below $7 a pound. We still see copper, although it's not as low, is still at a reasonable price when we consider the projections. You look at lithium, around $10.50 per kilogram. I mean, cobalt was another one that we were discussing should be stockpiled back when it was below $10 a pound, and now we just broke $20 a pound this week. So it continues. European Commission President Ursula von der Leyen told EU lawmakers on Wednesday that, quote, a crisis in the supply of critical raw materials is no longer a distant risk. In a work plan for next year, the Commission this week said that it would set up a, quote, critical raw materials center to monitor, jointly purchase, and stockpile minerals. But Europe will have to compete with the United States, which has already stepped up stockpiling with a $1 billion buying spree. And this is a thing. The money that's being thrown at this, sure, $1 billion seems like a lot of money. But when we're talking about the building blocks of the supply chain, as far as I'm concerned, you could add 2 zeros to that. If your car manufacturing companies are about to shut down, I mean, what are you willing to pay? I would guess it's closer to $100 billion. So it's quite interesting from my perspective how low the budget is on these metals. So they're competing with the U.S., and the bloc's limited mining or refining capacity makes it difficult to secure minerals, from graphite and cobalt to gallium, needed to produce military equipment such as fighter jets, precision missiles and radar systems, and green technology such as wind turbines and magnets. So Europe is stockpiling, and also on the European-Chinese relations, we have a headline from Reuters via mining.com. High-level Chinese officials to visit Brussels to discuss rare earth export curbs. So meetings have been scheduled for Chinese officials to visit Brussels in the coming weeks to discuss Beijing's export curbs on rare earths. And we have a quote from European Council President Antonio Costa, who told media in an interview on the sidelines of the ASEAN summit in Kuala Lumpur, quote, we're very concerned with the trade relationship with China, especially the recent measures that China adopted regarding the export control of critical raw materials. A high-level delegation from China is going to Brussels in the coming weeks, and we hope to address these in the proper way. So the Chinese coming in several weeks kind of seems like they're in no rush. Probably with every passing day, their negotiating leverage increases. Continuing on, we have a big story in the New York Times, step-by-step how China seized control of critical minerals. And it dates back to October 1st, 2024. The opening shot detailed documentation requirements. Then on December 3rd, 2024, restrictions of 4 non-rare earth minerals. Then on April 4th, export controls on some rare earth metals and magnets. Then on October 9th, stopping transfer of rare earth technical secrets. I mean, that had begun before October 9th, this stopping of rare earth technical secrets. We've been hearing about that for months, actually. And also on October 9th, according to the New York Times, halting export of rare earth processing equipment. That also we had been hearing stories about before October 9th. So perhaps this was a formalization of this initial directive, but that's been happening for more than a few weeks here. Also, October 9th, blocking exports of 5 more rare earths. And also October 9th, restricting battery manufacturing equipment. So that is a big one that we haven't heard too much about. Also October 9th, prohibiting export of diamond saws and similar gear. And these are used in manufacturing semiconductor and solar wafers. Also October 9th, controlling the trade of rare earth magnets made outside China. Basically, if there's even 0.1% of the magnet's value in the magnets, the ministry is saying you need permission from them in order to trade them. And then on October 14th, halting exports to Europe of Nexperia computer chips. And so that is where we are right now. It has been quite a story. I've been calling it one of, if not the, story of 2025. And so I guess we'll see at the end of the year, when all of the top 10s come out, how I do there. Now, following up on Nexperia, we have an exclusive from Reuters from October 23rd. Quite an interesting development. Nexperia's China unit resumes chip sales to domestic distributors, sources say. But wait till you see the details on this. Dutch chipmaker Nexperia's Chinese unit has resumed supplying semiconductors to local distributors, according to 2 people briefed on the matter, having previously halted all shipments when Beijing banned exports following an ownership dispute. But as part of the resumption, which is confined to domestic trade, all sales to distributors must now be settled in Chinese yuan, the people said, whereas transactions had previously only used foreign currencies such as the US dollar. Now, what else is interesting about this is we're getting stories about BHP in negotiations with China on iron ore shipments. And one of the stipulations that was being mentioned was iron ore being bought in yuan. So an interesting response from China on the seizure of Nexperia by the Netherlands. Another headline, this is the Financial Times, relating to Nexperia. Nexperia's China unit says staff can ignore orders from Dutch headquarters. So China is not taking the seizure of Nexperia, or as Reuters is putting it, the ownership dispute, lying down. And just a headline here, Javier Milei win cements U.S. partnership in Argentina mining. So it looks like Javier Milei has had a landslide victory in Sunday's midterm elections in Argentina. So miners probably breathing a sigh of relief, one imagines, in Argentina. And finally, this is CNBC, Google and NextEra to revive major Iowa nuclear facility as AI energy demand surges. So also a huge component is energy. And so we're seeing the nuclear renaissance return. So lots going on out there. And to help us put it all in perspective, we have Theo Yameogo, EY America's metals and mining lead, who discusses EY's new report on the top 10 business risks and opportunities for mining and metals in 2026. We discuss what has changed in the last year. What are the risks? What are the opportunities for the mining industry in 2026, courtesy of EY America's metals and mining lead, Theo Yameogo. So a wonderful interview coming up. We also have some incredible stories about what's happening with the zinc market and more. If you want to find us online, you can find us at northernminer.com. You can find us on X at Northern Miner. You can find us on Instagram at The Northern Miner, and on Facebook, LinkedIn, and YouTube, where we also host these podcasts and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to the news. Turning to the website, there are big things happening in the zinc market. We have a column from Reuters describing it, and this is by Andy Holm at Reuters. LME zinc turns wild after bears sleepwalk into squeeze. And this is part of a larger theme we've been seeing of stocks running low on the LME. The London Metal Exchange zinc contract has taken a walk on the wild side this week, with time spreads flaring out to record levels against a backdrop of depleted exchange stocks. The zinc market has been sleepwalking towards this storm for several months, confident that falling LME inventory wasn't a true reflection of a market in growing supply surplus. Yet metal has continued flowing out of LME warehouses, leaving just 35,300 metric tons, barely enough to cover one day's worth of global consumption. Arrivals have been minimal despite the widening premium for cash delivery. The result is a ferocious squeeze as bears pay the painful price of mistiming zinc's shifting dynamics. So apparently there were 300,000 tons of zinc sitting in LME warehouses, most of it in Singapore, this time last year. Scrolling down, something, however, changed around the start of this year. Zinc was leaving LME-registered stocks but not appearing in the off-warrant shadows ready for renewed warranting at a different warehouse. Rather, Singapore's trade data showed rising exports of refined zinc to destinations as far as Djibouti in East Africa and Guatemala in Central America. Since the city doesn't have any zinc smelters or refineries, it's a fair bet that what has left LME stocks has been slung out to the rest of the world. So how come the rest of the world is short of a metal that is supposed to be in supply surplus? The clues lie within the latest biannual statistical update from the International Lead and Zinc Study Group. While zinc demand growth is flatlining and mine supply is booming again after 2 years of contraction, Western smelters have been powering down or closing altogether. ILZSG expects global metal output to rise by 2.7% this year, but this is all down to China, where refined zinc production is on course to surge by 6.2%. Quite evidently, production outside of China has been falling as smelters reduce run rates, or in the case of Toho Zinc's Anaka smelter in Japan and Glencore's secondary zinc operations in Italy, close completely. The result is that this year's projected supply surplus is a relatively modest 85,000 tons, and it's all in China. And so this brings us back to the larger issue here. Everybody seems to be focused on the rare earth and critical minerals, in other words, the specialty minerals that are needed for the next generation economy. But as Wayne Gretzky said, skate to where the puck is going. It seems as if we have a few fires brewing in industrial metals, such as zinc and copper. Finally, given the regional imbalance in availability, it's no surprise that the London premium over the Shanghai Futures Exchange zinc price has been widening. So interestingly, zinc sounds like it's cheaper in Shanghai. Chinese exports to LME warehouses are the most obvious ways of reconciling the disconnect with the market outside of China. The bad news for LME short position holders is that physical arbitrage takes time and they need the new metal today, which is why the cash premium over 3-month metal has exploded to over $300 per ton, the tightest market conditions since the launch of the LME special high-grade contract in the late 1980s. So what Andy Holm is saying here is we have the tightest market conditions in the zinc market since the contract was launched in the late 1980s. So clearly interesting times in the zinc market. More concerns around aluminum in Indonesia and this notion that Indonesia could do to aluminum what they did to nickel. We have this story from Reuters via mining.com. Chinese firms drive aluminum expansion in Indonesia, raise surplus fears. A major expansion of aluminum production in Indonesia, driven by Chinese companies, is expected to push the global market into a surplus next year, which will lower prices of the metal widely used in the transport industry. It's kind of back to my speech I gave at the Vancouver Resource Investment Conference last year, where you see in the Copper Age, the Bronze Age, and the Iron Age that basically whoever controls the metals and the most advanced metal processing technology dominates the civilizations around them. And it's almost as if China understands this, and that is why they are pushing across the board to dominate the metals markets, as they already do, but that push seems to be continuing here. A major expansion of aluminum production in Indonesia, driven by Chinese companies, is expected to push the global market into a surplus next year, which will lower prices of the metal widely used in the transport industry. I think the real solution to this in the West is actually what they're starting to do in the West, but don't just do it for critical minerals. In other words, if China wants to sell the world nickel and aluminum at rock bottom prices, then buy it, is, I think, how you counter this. Indonesia exported 325,000 tons of aluminum between January and August this year, up 67% from a year ago, compared with 11,000 tons in the first 8 months of 2023, according to Trade Data Monitor. And we have a quote from Ross Strachan, analyst at consultancy CRU. Quote, "The pace of Indonesian supply growth is going to play a key role in shaping aluminum market balances and prices. Primary production of aluminum, also used in construction and packaging, is estimated to exceed 72 million tons a year. Goldman Sachs projects a global aluminum market surplus of 1.5 million tons in 2026 and 2 million tons in 2027, with Indonesia's primary production rising from 815,000 tons in 2025 to 1.6 million tons in 2026 and 2.5 million tons in 2027. Quote, "The new supply coming from Indonesia effectively resolves the global supply gap that we previously saw forming as China reaches its smelting capacity cap, at least for this decade," the bank said in a note earlier this month. So it kind of looks like China and Indonesia are trying to do a repeat on what we've seen in the nickel market, this time in aluminum. Continuing on, Rio Tinto flags uncertain future at Australia's largest aluminum smelter. This is Reuters via mining.com. Rio Tinto warned on Tuesday that Australia's largest aluminum smelter, Yameogo, may be forced to shut down as it struggles to source power at commercially viable rates beyond 2028 when its current power deal expires. Yameogo Aluminum is the biggest power user in New South Wales state, and like a slew of Australian smelters that are struggling with high energy prices as the country transitions to renewables, it was built last century to take advantage of Australia's plentiful and cheap coal. Power makes up more than 40% of Yameogo's operating costs, and both coal-fired and renewable options are expected to rise sharply in price once its existing contract expires, jeopardizing the smelter's commercial future, Rio Tinto said. Quote, "Finding competitively priced energy remains the central challenge," Rio Tinto said. So it's quite interesting to see this crucial relationship between energy and metal production manifest itself repeatedly. We're seeing it with AI as well. And we have a quote from Yameogo Aluminum CEO Jerome Dozel, who said in a statement, quote, "Unfortunately, all market proposals received so far show future energy prices are not commercially viable, and there is significant uncertainty about when renewable projects will be available at the scale we need." Rio Tinto has said that decarbonizing the assets needs solutions supported by state and federal governments. Indeed, it does seem as if this statement is geared towards the government and basically looking for help here. Continuing on, JP Morgan Agnico Eagle poured $255 million into Perpetua Resources. This is by Cecilia Jamasmi at mining.com. And we've been seeing JP Morgan just recently announce a huge investment initiative into sectors that are considered crucial to the supply chain, including mining. Perpetua Resources has secured $255 million in new investments from JP Morgan Chase and Agnico Eagle, giving the U.S.-focused gold and antimony miner a major boost as it builds its flagship project in Idaho. JP Morgan will contribute $75 million from its $1.5 trillion investment fund created to strengthen U.S. national security. The deal, expected to close Tuesday, gives the bank nearly a 3% stake in Perpetua. JP Morgan also holds about 20,000 shares, according to data from the London Exchange, and can exercise $42 million in warrants over the next 3 years. The investment follows the start of construction last week at Perpetua's $1.3 billion Stibnite gold antimony project in central Idaho. Fast-tracked by the Trump administration, Stibnite is part of efforts to rebuild a domestic supply of critical minerals. And we have a quote from Doug Petno, co-CEO of JP Morgan's Commercial and Investment Bank Division. Quote, "With this investment, we are supporting a company in an industry critical to national security and American resiliency, precisely the focus of our new initiative." Scrolling down, Canadian gold miner Agnico Eagle will invest $180 million for a 6.5% stake in Perpetua and will assist in developing the Stibnite project. So, very interesting development there. Continuing on, Trump reverses Biden-era rules on copper smelters. This is Reuters via mining.com. U.S. President Donald Trump on Friday reversed a Biden-era air pollution rule that had imposed stricter limits on emissions from copper smelters. The copper rule, finalized in May 2024, had required smelters to curb pollutants including lead, arsenic, mercury, benzene, and dioxins under updated federal air standards. Trump's proclamation grants a 2-year exemption from compliance for affected stationary sources, which the White House said would help promote American mineral security by reducing regulatory burdens on domestic copper producers. And we have a quote from the White House, quote, "Imposing these requirements on such a limited and already strained domestic industry risks accelerating further closures, weakening the nation's industrial base, undermining mineral independence, and increasing reliance on foreign-controlled processing capacity." So, deregulation for smelters in the United States. Continuing on, CMOC to invest $1.1 billion to expand Congo copper mine. This is Reuters via mining.com. China's CMOC group will spend $1.08 billion to expand its KFM copper mine in the Democratic Republic of Congo to add about 100,000 metric tons of output per year, it said on Friday. It will launch the second phase of its KFM project in 2027. The first phase of KFM reached full capacity in 2023. The investments come as copper supplies face possible shortage amid mine worldwide disruptions, including the suspension of Freeport's flagship Grasberg project in Indonesia. Continuing on, Barrick's seized Mali mine restarts under state management. This is Bloomberg News via mining.com. Operations restarted at Barrick Mining's massive gold mine in Mali for the first time in more than 9 months after a state administrator took over the asset in June, according to people familiar with the matter. Production activity resumed at the site last week, two of the people said, asking not to be identified, discussing information that's not been made public. That came after a deal to restart payments to contractors, which had been suspended when Barrick halted operations, according to one of the people. Mali's mines minister Amadou Keita said in June that the provisional management team would, quote, restart operations, produce, pay the workers' wages, but also produce gold for the national economy. Continuing on, Newmont said to ideal for Barrick's prized Nevada assets. It's Bloomberg News via mining.com. Newmont is studying a potential deal to gain control of Canadian rival Barrick Mining's prized Nevada gold assets, people with knowledge of the matter said. Denver-based Newmont has a minority stake in a Nevada gold mining joint venture with Barrick, which is operated and majority-owned by Barrick. Newmont is in the early stages of considering various transaction structures that would allow it to gain full ownership of the assets, the people said, asking not to be identified because the information is private. It's unclear how receptive Barrick would be to any overtures, especially as the Nevada gold mines are considered to be among its most valuable assets. Newmont could consider options, including a bid for Barrick's stake in the venture, as well as a full takeover of the company, followed by divestments of assets it views as non-core, the people said. And we have a story from Frederick Temesco on October 24th on the Northern Miner. Could Barrick's next CEO break up the company? Spinning off Barrick Mining's U.S. assets into a new company or exploring a merger with Newmont are some of the key options that the Canadian miner's next chief executive officer will need to weigh, analysts said. Scrolling down, Brissow's surprise exit spurred some analysts to speculate that the company might be poised to sell some of its underperforming assets. A breakup of the company could even be envisaged under the right circumstances, according to former Newmont president Pierre Lassonde. Quote, is there value in at least looking at some scenarios? I would say yes, Lassonde told the Northern Miner in an interview. Longtime mining analyst John Tumazos agrees. Quote, there are some open strategy questions that have always been possible that a new CEO on the board might address, one of which is to break up into 3 companies. Tumazos, head of New Jersey-based Very Independent Research, said in a recent interview. So interesting talk around Barrick. Those are your news stories. Now, let's take a look at metal prices. Turning to metal prices, let's take a quick look at the bond market for context. The U.S. 10-year bond is yielding 3.97%. That is unchanged from last week, so staying steady just below 4%. The UK 10-year gilt is yielding 4.38%. That is down 0.12% on the week. Italy's 10-year bond is yielding 3.39%. That is up 0.03% on the week. And France's 10-year bond is yielding 3.41%. That is up 0.05% on the week. And significantly, that is higher than Italy's 10-year bond yield. Germany's 10-year Bund is yielding 2.61%, that is up 0.04% on the week. Japan's 10-year bond is yielding 1.64%, that is down 0.02% on the week. Turning to precious metals, gold is trading at $3,918.50 per ounce. That is down $354 on the week, so big drop in gold. Silver is trading at $45.69 per ounce. That is down $2.95 on the week. Big drop in silver as well. Platinum is trading at $1,575.40 per ounce. That is $63 lower than last week. And palladium is trading at $1,419.50 per ounce. That is $97 lower than last week. Turning to industrial metals, copper is trading at $5.13 per pound. That is 13 cents higher than last week. Iron ore is trading at $105.41 per metric ton. That is 6 cents higher than last week, so edging slightly higher. Aluminum is trading at $1.31 per pound. That is 5 cents higher than last week, so a bit of a breakout in aluminum. Lead is also higher at 92 cents per pound. That is 2 cents higher than last week. Nickel is trading at $6.92 per pound. That is a penny higher than last week. Tin is trading back above $16 at $16.24 per pound. That is 35 cents higher than last week. Cobalt has broken $20 to $22.03 per pound. That is $2.65 higher than last week, so more than 10% higher on cobalt. Lithium is trading at $10.77 per kilogram. That is 38 cents higher than last week. Uranium is trading at $76.90 per pound. That is $1.10 lower than last week. And finally, zinc is trading at $1.39 per pound. That is 4 cents higher than last week. So zooming out, precious metals correct, while industrial metals sail higher, with cobalt really the big standout there, and aluminum also breaking out. And those are your metal prices. Coming up, I'm very pleased to welcome back to the Northern Miner Podcast, Theo Yameogo, EY America's Metals and Mining Lead. We discuss EY's new report, Top 10 Business Risks and Opportunities for Mining and Metals in 2026. It is a topical discussion with a fair amount of surprises in it, so I hope you'll enjoy the conversation, and I will see you on the other side. Joining us today, I'm very pleased to welcome back to the Northern Miner Podcast, Theo Yameogo, EY America's Metals and Mining Lead. Theo, welcome back.
Happy to be here, Adrian.
It's always a pleasure to have you, Theo. I feel like we do this at least once a year where EY will put out a very interesting report on the major risks and opportunities for companies in the mining sector. Here we are. What has changed in the last year since EY released their last report?
Well, typically, as we do, Adrian, let's talk about what went down, when went up, and what's new, right? So if you think about what really went down in terms of priority, there's a lot of them. And, it's mining and metals, so the environment is always changing. So, for example, changing business model is done from last year. We have sustainability went down, it's on number 9. We have geopolitics that went down and capital that went down. Now, typically what we tell people based on the surveys we're getting from the sector is that those don't go down because they're less priority than others. They go down because the sector has figured out a way to deal with them that made it that it's not a burning platform like it used to be. Now, it's still in the top 10, but it's not as burning as it used to be. And then if we think about risk and opportunities that kind of stayed at the same ranking, we're thinking reserves and resources, because as you know, we face more and more with harder to get metals and minerals. So reserve resources stayed at number 4. License to operate stayed the same. License to operate, as you know, is super critical in the sector because it involves government, but also communities and consumers. And if you think about risks that went up, well, rising costs and productivity went up, and digital innovation went up. Now, digital innovation went up, no surprise there. We're now talking so much about AI, so much about data ready for AI, and even non-mining audiences are asking, well, what are you guys doing about AI? It's now like a generic question. So digital innovation, no surprise there. Digital innovation is also important because in innovation, you have to think about hard science innovation. Sometimes when you say innovation, people think about software and just like, the app technology, but also hard science innovation in extracting more from the resources we have, figuring out better ways to, mine underground and change mining methods. These are all innovation that are more like hard science innovation. And of course, rising cost and productivity always been kind of part of the top 10. But this year is number 2 because it's really impacting margins and profitability. And the new entrants, last year workforce was below the top 10. This year workforce is back number 6, which is a major jump. And operational complexity is a new entrant, completely different. It represents the summary of how complicated mining operations have become and how sensitive companies' productivity is now tied to the complexity of the operation. So such complexity can go from just the way the ore body is it deeper, is it low grade, to things like how do we extract the metals in a complicated set of minerals, like, byproducts and so on. So in summary, that's what we're saying. So yeah, this year number 1 is operational complexity. It's a new entrant and it's a very important challenge for the sector.
It's super interesting. So this is a survey, right?
Yes.
So when you say operational complexity is a new entrant and is now at the top, is that because EY had it as a possible answer this year and then everybody kind of jumped on it? Or was it an answer that was, previously available in the survey that people weren't as concerned by? Like it is quite head turning to see operational complexity at the top. Quite interesting.
Yeah, so this is very important. It's a very important question because some of our peers have a different approach. We interviewed 500 mining executives, okay, and different regions, different commodities, different levels of seniority from like the director level, like director as in director in operation or in finance and whatever, and then all the way to the board of director level. And we asked a set of questions, and from the results, we then deep dive and then we get a better understanding of what it is. We also go back to some key ones to show what we've heard to make sure it's validated so that it's not outside in view, but it's more of a collective understanding of where the sector is. For example, we talking about operation bottlenecking or debottlenecking, depending on what you see, and clients are commenting of where they're having issues. And then we do a deeper analysis of what it means. So, for example, we've noticed that it's going to give you a simpler one. If you look at the impact of missing earning in operation. So we're thinking about, a company miss production targets, let's say, and it misses earning by 1%. We notice it triggers a 0.2% share price dip from an operation perspective. So they missed production, which means they missed earnings, and that's direct. Okay. We also noticed that when they beat earnings, they didn't outperform by 1.7 points. Right. So we started looking at what is the impact when people say, "Oh, we missed production." We then asked the sector, what are the key bottlenecks in their operations? Because at the end of the day, it's an operation. We have produced these metals and minerals. And labor availability is a big problem. So no surprise there that then we see workforce coming up. So 31% say labor availability is a big bottleneck. Processing plant capacity, another big bottleneck, 30%. Transportation logistics, 28%. That's the constraint. Reserve grade variability is 27%. Reserve grade variability is really that we're getting in more and more complex ore bodies because the easy ones are most likely gone. So either it's deeper or it has a complex matrix of geological settings. And then we have reliability issues on plant and equipment. We've seen basically, if you analyze the quarterly calls and reports from mining companies, you're starting to see some of these operations reasons why production was missed, which then end up missing earning, and then you can see the impact on the share price. So that's one of the ways we did that. The other thing we did is if you look at the copper grades, it's down globally, and copper is a critical minerals and it's the anchor metal when you think about the future of the sector. And because it's down by 40%, it takes operation much more activities and effort to produce the same amount of copper. So that's another one we've seen, right? So yeah, there's a lot of reason why operation complexity is up there, but it makes a lot of sense because it's more of a summary of a lot of other challenges.
Indeed, I was going to say it's almost like it's an umbrella or catch-all term, so to
Mm.
speak, to declining grades, difficulty in finding people to work at the mine, rising costs, and all of it put together. In a sense, though, if we were to really kind of simplify it, I mean, is this another way of saying that mining is becoming a more difficult business?
Yes, yet it's actually at a time where it's more needed by societies around the world. It's at a time where it's on the lips of most global leaders. Like if you look at the ASEAN meeting going on right now in Malaysia, there's a lot of talks about critical metals, critical minerals. But when you think of it, most of it is actually critical. It's now a big topic. When the G7 was here, was it last year? That was also in the final communique, which tells you that, okay, it's super critical. So the more the world is demanding those minerals and metals, and the more investment the sector is doing, the more people realize how complicated or complex operations are.
And just on that point, I mean, I think we discussed this the last time, maybe during the G7 or right afterwards. I think we had a conversation. I mean, what is your sense of the progress that is being made here? In a sense, there are the speeches, and then there's I suppose, the reality on the ground. It does seem like there is quite a bit of momentum here. We're seeing investments by the US government, for example, in
Mhm.
mining companies taking equity stakes. I mean, I don't know if you'd want to give a grade, but how significant are the changes you're seeing based on the speeches we're seeing?
I think it's advancing. You and I usually agree that as long as we're seeing progress, it may take longer, but we're seeing progress, right? So if you think about the nation building projects on that list, we have some serious mining projects. If you live in Ontario, you would have seen by now all the ads about the Ring of Fire and how Ontario will invest in Ring of Fire. There was a meeting in Europe with mining companies trying to sign deals in Germany. So is it fast enough is the question, right? But is it happening compared to like even 7 years ago when you and I started doing conversations like these? Yeah, it's progressing. It could be faster. Yes, it could be faster. But we have to also remember, like I said, license to operate staying on the top 10. More and more people will realize how many stakeholders need to be involved in the sector, right? It's not a simple sector. We don't just go and build a plant outside of the GTA and then next day we're producing. It's a complex sector where you need to answer questions from communities, but also from different levels of government on how you're going to do it, but also how you're going to share the wealth, how you're going to close it. These are deeper questions than traditional industrial manufacturing that we see. So I think as long as we're progressing, it's good. As long as we have society aware of it, it's fantastic. At EY, I mentioned this to Anthony Vaccaro. At EY, we actually built some content that we're taking to grade 5 to grade 7 and 8, explaining what metals and mining is about, explaining how important it is for society, not only in Canada but abroad. And the treasure hunt is also a fantastic idea. I know not money is behind it, and we sponsoring it, but we believe that we need the next generations to really understand the value of the sector and why it is important for society overall. So we're getting there. It's slow, but we're getting there.
Indeed, it isn't as simple as a government deciding, okay, we want to do this. Like it's politically complex,
Yeah.
almost back to our umbrella term, operational complexity. Now, rising costs and productivity moved higher and is at number two. Perhaps that's a bit surprising for people in the sense that, sure, we have, 3 or 4% inflation, but nothing too crazy. Where are the costs coming from? Where are costs rising?
Yeah, this is a very interesting question, and I think some of us were surprised to see it. The reason is this year we actually took a stab at looking at it commodity by commodity, right? And then if you look at it commodity by commodity, you could see that actually the energy cost for lithium is way up. Okay, like it went up substantially. You can see that silver went up, nickel went down, but we don't really, I think mostly because we're changing also the energy mix for nickel. If you look at labor costs, it kind of stabilized compared to last year, but it's still up. Okay. So that's the first thing is labor energy cost. Now, in the details, if you think about corporate income tax and royalty rate, because this is also cost, right? The ICMM members average about 40.6% in 2024, and that's up 7.7% from 2023. So that also has an impact. If we look at the total reporting numbers from ICMM, the International Council on Metals and Minerals, basically wages went up and investment in community and social program also went up. ICMM members paid about like 1.5 billion US in community and social programs in 2024. So that explains a lot of, okay, why is the cost up? We actually believe that productivity is, and by the way, we started talking about this in 2014. Productivity is a greater measure on how things are going in terms of cost. So looking at input and output ratios, trying to balance where we need to have some of the programs to reduce the cost. So for example, on energy, we're thinking that having less exposure to the global markets on like fuel will help. So thinking more like renewable energy, thinking more about reusable energy and anything to actually reduce exposure to energy price swings, right? Labor here is kind of related to the digital and innovation, but also workforce is trying to automate as much as possible and using AI as much as possible to get the productivity up. So people would spend less time doing wasteful activities. So yeah, the costs are rising, productivity is dropping, and we need to kind of balance it again.
The more we discuss this, the more it feels like each one of these categories are part of a larger kind of ecosystem. Maybe rising costs is part of ore grades declining, let's say, and also part of workforce. And this all adds to complexity, right? So
Yeah.
it's almost like it's different emphasis in each category. So, how big of a deal is ore grade, by the way? Like you touched on it earlier. I suppose it depends on the metal, but is there anything kind of big picture that stands out to you? People talk a lot about copper right now. Is there anything that stands out in terms of ore grades in that discussion?
Well, we always talked about all grades dropping as we do not discover new high grade closer to surface ore bodies, right? So it's an overall environment of it. Now, you take gold, for example, with prices going up, your cutoff grade will change. So then you can go get lower grade. But if price drops, then you have issues. So that's just a mechanistic in terms of price and cutoff grade. But overall, for copper deposit, when we say that the ore grade dropped by 40% in the last while, it's because we're trying to stay at the same output. And now we need to mine and process more material to get the same output, right? And when you go in that mindset, well, yeah, if you need to mine more material, mining costs are going to go up. And if you need to process more material because the grade is lower, your processing costs will go up. And processing costs, you basically have the energy that you need to add to it to get there. And then there's more people involved doing it. So you have labor. You may have more mines to just get to the same output. So these are all key points on the grade side. And some of the solution we've seen and appreciate in the sector are really focused on the district strategy. So we're starting to see mining companies teaming up on assets so that they can reduce their costs. So if you could use a conveyor belt for 2 months rather than use everybody gets their own conveyor belt, well, you got to reduce your cost. If you could swap out or grade depending on processing plan. So let's say you have a processing plan for low grade, I have a processing plan for high grade. Rather than me building second processing plan, I basically do a collaboration where I send you the grade that works with your processing plan, and you send me grades that work with mine. So we see that happening a lot more, and that we coined it district strategy. And basically, mining company in the same environment should work together to figure out how to reduce the cost profile.
That is super interesting. It's like on a more, for lack of a better term, communal level, there's more business efficiency. There's more
Yeah.
teamwork, so to speak, which is perhaps encouraging.
Yeah, we see a lot of it happening in Latin America and the copper districts, which is good. We're hoping to see more happening in the US and Canada, and even in the copper countries like the DRC. You kind of hope that companies figure out a way, as long as it's still within the boundaries of the law, figure out a way to exchange and fast track project, but at the same time reducing costs.
Okay, excellent. So as we start to wrap up here, Teo, I want to talk about ESG briefly. It's
Yeah.
interesting. License to operate has stayed where it is. Sustainability, interestingly, has come down. I think the general sense, particularly since the last US election, is that with the focus on critical minerals and the supply chain and really the urgency for the whole thing that we've seen, say, in the rare earths discussion most poignantly, it seems that ESG has taken a back seat from where it was, remember, 5 years ago when that's all anybody could talk about, and that was the main topic of every conference. Can you unpack this a little bit? It's interesting. License to operate stays the same, sustainability lowers. What's going on with ESG, Teo?
So there was always a challenge to define one versus the other from the get go. I think it's important to think of a license to operate as something really tangible, whether or not you operate in symbiosis with the communities, government, and every stakeholders. Whereas sustainability had more of a reporting and measuring KPIs. It seems like that in people's mind. And what we've noticed is that if you think about sustainability, you think about adopting like ISSB rules, like IFRS 1 and 2, for example. And it looks like we have issued enough rules and legislation that people are adopting. So it's not like it's slowing. It's just that as we check the box on all the things we need to do on sustainability, it drops in your priority on the yearly, like at the yearly basis, right? So that's what we're seeing. And because mining companies and communities, sometimes at association level, are adopting all these regulations, well, then they have less imperative to do those because they're actually up to standard. However, why is it still in the top 10? Is because greenwashing is still an issue. So transparency around greenwashing. Because remember, it's still number 9. So it's very important when you think about the industry as a whole. So greenwashing is still important. We also noticing that the industry invests in nature positive projects that are harder to measure because sometimes they're longer term, sometimes they're not as clear. So that makes it accessibility still on the list. I don't think it's less important or slowing down. I think it's just that there's other priorities that makes it accessibility number 9. But use of water is still critical. Using less water or reusing water, because water management is still an important topic for communities around the world. So that's still critical.
Okay, excellent. And in terms of just finally on digital and innovation, and of course, AI, we seem to have an industry in transformation. And, you mentioned, innovation can be hard science. You hear how biotech is
Yes.
starting to change mining, processing of metal, which is quite
Mhm.
fascinating. So, Could you speak a little bit about what you're seeing, say, in AI and the kind of innovation? Is there anything that stands out to you in that whole discussion?
Yeah, so we knew AI was going to be important. So we're very purposeful in the questions that we asked our audience. And one of the biggest surprise to me is that 21% of the major mining companies plan to invest more than 20% of additional budget in AI in the next 12 months. That's like immediate, right? Usually in mining, they're like, oh, yeah, we don't think it's a place, right? Let's wait. So that was a big number in my mind. And I think it's also part of addressing some of the earlier topics like complexities in operations. As you know, AI is supposed to simplify things for humans, right? So in the details of the questions, what we ask is, okay, what would you use this AI for? And basically, is reducing operation complexity, addressing skill gaps because we have differences in generation. So, like 69%, they report they need to have digital capabilities. Digital capabilities being not only having digital tools, but also making sure people can learn digitally. So it's seen there as something really, really important. And we expect AI to be adopted now. What is interesting for the sector to do, and I think we talked about it more in the productivity section, is really creating a sort of discipline in execution, some sort of a standard in processes, some sort of standard in data management that would make AI application easier to implement because AI doesn't really work well if things are not disciplined and work a certain way, right? So we expect that that investment in the AI will also touch on productivity and operation complexity because we need to simplify the operations. We need to have discipline in execution, understand all processes, and then we can layer on AI to actually, reap the benefits of that boost, right? So that's what we see. For example, on digital, there's one of the respondent talked about how it extends mine truck life, right? Trucking is important in most operations, and they were able to increase the truck life from 80,000 to 170,000. So that reduces your cost, reduces the time to change it. So yes, there'll be digital as in AI, as in discipline operation, as using data properly. And innovation can take different forms, and it can be hard science innovation, but it can also be really using more technology or like AI in processing, for example. And you already heard of this company starting to use AI in exploration. So that's what we see. So it's good to see it back in the top 10.
Just finally, is there anything we haven't discussed on the report that you think we should highlight? And if people want to find the report, where should they go?
Well, let's start with where should they go. I think the EY Top 10 Men's and Mining report is probably one of the most rare reports that we publish as a firm. So whoever they type ey.com and go to Men's and Mining Top 10 report, make sure you have the latest one. But yeah, they should be able to access that. We didn't talk about capital. Capital is still in the top three. So figuring out ways to raise money, figuring out ways to allocate capital for M&A, but also for JVs is still going to be an important point. Mining is a heavy capital consumer, so we still see that as very, very important. In a way, operation complexity covered the fact that resources and reserves are harder to get, so the depletion is there is very important. I think another one that I'd like to mention is geopolitics. It went to number seven. Not that it's less important, but the sector is coping more better and better with it. And like you mentioned at the beginning, governments are investing directly into major mining companies, whether it's the processing or the mining side. And it's now a topic of global trade between countries. So geopolitics is still going to be important. And finally, on the business model side, is we're seeing more ambition to do vertical integration, whether directly or through JVs. And we expect that given that the sector will have hard time producing enough metals and minerals to address the demand, we will see more contractual arrangement between the sector and other players in other sectors to basically solidify and lock in supply.
Theo Yameogo, EY America's Metals and Mining Lead. Thank you for joining us and sharing your perspective and everything you're working on at EY.
Always a pleasure.
Thank you once again to Theo Yameogo for appearing on this week's episode of the Northern Miner Podcast. Thank you, dear listener, for continuing to support this program. If you want to help out the podcast, please leave us a review in the Apple Podcast directory, share it with your friends, and until next week, take care.